I just want to welcome everyone on behalf of the GTDC here to our channel chat series that we do with our data partners, IDC. See some familiar faces joining and some new ones, so welcome. Um, I'm Kavita May with the GTDC, and I want to go ahead and get started, and I'll introduce our CEO, Frank Vitagliano, to get us started.
Hey, Kavita, thank you and welcome everybody. And as Kavita said, this is our quarterly GTDC/IDC webinar that we do that provides a good overview of a number of things. We've got the agenda up. I'll give you a quick GTDC update on a couple of things we've got going. Second, we'll talk about the macro environment and what's happening, from that standpoint. And then, of course, we'll get into the details with the North America distributor data, which will be through third quarter, actually October 6th, I think, is what I saw there. So week 40. So that'll give you a good indication of where we are, 3 quarters in. And then finally, the channel opportunities as we move forward. And we'll leave some time at the end for Q&A. So if you have any, or you can send them, via sending us a note here, and we'll note them. Okay. So today we've got 3 speakers. I will be done very shortly, and I'll turn it over to Loren Loverde, who's the IDC VP of Data and Analytics. And we also have straight from Milan, Italy today, Gabriele Roberti, who is also with IDC, and his title is Director of Data and Analytics. And he'll give us an overview and some details from his area. So let me talk just a minute about GTDC. We've got a lot of things happening. We've got 3 summits coming up in a span of 6 months, it looks like here. Yeah. In a couple of weeks, we will have our APJ Summit in Singapore. It'll be really our first one. We're really excited to be launching that. We've got a number of, industry executives signed up. Of course, all the distributors that are part of GTDC doing business in Asia will be there, in addition to a couple of new ones, including Reddington and VST, which is significant for us. And then in February 19th to 20th, we'll do the North America Summit in California, and shortly thereafter with EMEA in Madrid, Spain this year. So 3 summits coming up. Looking forward to it. If you haven't registered for them, please do so. The registration is certainly open for APJ. Just got open for North America, and we'll be opening EMEA here probably in the next, couple of 3 or 4 weeks, and you'll be able to do that. The other thing I'd like to comment on is our ongoing research. So if you go to the next slide, Loren, yeah. So we just released, or actually we will release here in November, a cybersecurity report, which came from a lot of requests from the vendor community and folks that we work with within GTDC to talk a little bit about how IT distribution empowers cybersecurity in the marketplace. And we all know that's an ongoing, enduring, critical area that will remain critical. So look for that. All of that's available on our Knowledge Hub. With that, Loren, I'm going to turn it over to you.
So thank you, Frank, and thank you everybody for joining. I think we've got some really good content for you today, and certainly a lot going on in the market, which I hope to shed some light on from a NADT perspective. So let's jump right into it here. So I'd like to start with inflation, and we've been talking about this, for the last couple of years. I'm sure folks have heard in the news, but we had some, significant improvements in the last couple of readings. The U.S. inflation dropped to 2.5% in August. That was a 0.4% improvement, which is fairly substantial, and it's down to 2.4 in September. Food inflation, which is, a very consumer facing portion of inflation that affects everybody, has averaged just 2.2% since February. So, we had lots of news about egg prices and milk prices and so on, but on average, really, that's pretty good, stable, low trend. And then on the left-hand side, I've presented these before. The same data, the left-hand side includes energy, where you've got gasoline in green that has had the most volatility. And in September, that reading was negative 15%. So prices declined by 15%. Overall energy was down almost 7%. On the right-hand side with the orange circle, you can see that shelter and services are the most persistent. So on the one hand, they're inhibitors in the sense that they're still above 4%, 4.5%, high fours. On the other hand, they are coming down. And so we are seeing regular progress. So the net takeaway here is that the economic environment is improving. Building on that, we have GDP forecasts, and the charts in the bars here represent September data. And the circles are areas where we expect to see change in October. And I haven't published October, or I haven't included full October because they're incomplete and haven't been published yet. So I don't have final numbers, but I do want to point out a couple of changes. So the biggest of them is in the US, we had 2.4% GDP expectation for 2024. That's the orange bar. The prior forecast, the last couple of months, we've had a much, we've had a more pessimistic view going down to 1.4 in 2025. Well, given the latest data, that's now pushed up to 2.5%. So it's actually expected to accelerate in 2025% in the latest data. Canada and EMEA were already expected to improve. APJ, so all of Asia, was flat, but we're expecting an improvement in China numbers and potentially other countries related to additional China stimulus, and that things haven't deteriorated faster. So you've got a substantial improvement in the US view, at least a bit of an uptick in China. Those are the two biggest economies. It's clearly going to push up the worldwide expectation. And so, that's led to discussion of a no landing scenario rather than a soft landing. So we've been in this environment where there was recession concerns, and even if it was a mild recession or a near recession, that would have been a soft landing. And now the numbers have just been consistent. There's more chance that we will not see a substantial dip than that we will get close to a recession. So discussion of a no landing scenario. So, synthesizing all of this into one slide, we've got improving economic outlook. We have a reduced recession risk and the potential for this no landing scenario. We do have risks that continue. I've highlighted election turbulence, which is, in the US, we've got our presidential elections in 2 weeks. And there's ongoing geopolitical issues, whether it's China trade or Ukraine war, Middle East. We've got, lots of things going on that could change pretty substantially. But we haven't seen major disruptions, and economically we're improving. So in the two, we look at IT spending and activity. We've got really phenomenal growth in service providers investing in AI. So that's been a major accelerator. Software growth remains strong in double digits. Hardware is recovering. And, to the extent that we get more interest rate cuts, that'll fuel hardware as well as the broader economy. So all told, we've got, actually the first bullet here under 3, the rising IT outlook, is that our projections have actually increased steadily since the beginning of the year to now, and that trend looks to continue. So some of the risks like budgets being reallocated or pulled back due to economic or distribution channel issues have mostly been minimized. It's not that there aren't targeted reallocations or targeted changes, but we have not seen any broad-based changes. And Gen AI generally continues to be a broad driver. Businesses remain committed to digital transformation. And while we can never eliminate economic or geopolitical risks, they don't seem as imminent or as volatile at the moment. So all told, a very rosy picture. Let's hope it's not a naive Goldilocks scenario, but be prepared, but let's also not miss the opportunities in front of us. So that environment, I think, sets the stage and also will dovetail very well with some of the themes that we're seeing in the NADT data. So let me get into that. So the big news, big surprise here is that week 40, which is the first week in October, the most recent data, this is through October 6th, was up 37% year on year. So that's a pretty substantial jump, of course. The context is also important, as always. So I guess before I get through the bullets, let me draw your attention to the chart. And I want to first focus on the green oval. Those are highs in growth. I'm going to touch on the red line and the red circle, which are lows. The short little green line is kind of a short-term bottom, and the blue at the top represents maximum spending. So what we saw was a substantial decline through 2023. We had double-digit growth bottoms at the beginning of 5 quarters there, which you can clearly see the red line. Then we recovered pretty substantially in early and mid 2024. And then we kind of hit a lull. And so this week 40 result, it's a single data point. I don't want to oversell it, but it was a substantial reversion to growth. And I think you'll see that it opens the door for pretty substantial growth, or solid growth, at least in the fourth quarter. Anyway, so we had only a couple of positive weeks in the past 7, and that follows only 1 negative in the prior 9 weeks. So the last couple of months have been a trend of slowing down from a peak. Having said that, and so that reflects kind of challenges and market volatility. It also sets up this recent week 40 growth. If you draw down inventory, or if you postpone decisions, and then you decide, okay, well, we can't postpone it any longer, or we're getting low on inventory, then you need to make decisions. And so I think the week 40 results show resiliency, along with just some of the weekly volatility. From a rolling 4-week view, it's a little easier to see the trends. What I've highlighted here first is that 2024 is rebounding faster. So that right-hand dashed green line shows the trend from the beginning of the year through about week 32, which was the peak. And I've put an asterisk there to reflect that that was a trend before the market started to slow down. If you look at those peaks, we hit $7.3 billion in week 32. That was basically on par with the peak for 2023, so quite solid. It was also not far behind our pandemic era peaks, which is pretty strong. But the lows at the beginning of the year, one was the lowest in this chart, and the more recent one was basically in line with 2021. So way back in the pandemic cycle. So context underlying this improvement, but with a little volatility, and the importance of the week 40 results. As we've done before, the 2-year trend gives us a little bit more of a stable view and reflects the impact of compounding growth. So when you have demand shift from one period to another, this helps us understand and follow the trends. So here, I'm going to start with the dashed green curve, which is trending up, but it's still below zero. In this week 26, which was a recent peak, that was actually an all-time high, slightly just a fraction above the 2023 max. The growth peaks below the green line. So you can see that in late 23 and early 24, they were well below that line, but we've now hit another couple of peaks, which are pretty close to 2022 highs. And we do have the most recent bottoms near the red bar are on par with the lows. So again, trending up, but not avoiding volatility. The rolling 4-week view is really quite similar. That's probably the main takeaway here. The rebound was a little bit disrupted or less established because of the recent decline, but I think we have a big potential for year-end growth. If you look at the fourth quarter of 2023, the numbers are relatively soft, and so the comparisons there should be easier and boost growth. And you'll see that a bit more in some of the specific technologies like PCs, which we'll get to toward the end of the presentation. Okay, this slide compares the US and Canada for us. You'll see Canada in the blue line, start on the first on the left and then work your way across as you read it. Canada has continued a modest recovery. They hit growth of 13% in mid-August, but that has slowed below zero in September. The blue trend line doesn't actually show that because of the basically weighting and the way that the trend is calculated. So I've mentioned that in the past. You'll see a couple of examples of it again here. Worth keeping in mind. In the green line, we've got the Canada-US dollar exchange rate shown at a lag of 2 quarters, and that change is roughly inverse to the performance of the US trend there. What you'll see is that it was elevated in most of 2023. It's come down in 2024, and it's at an inflection point where it's relatively neutral at the moment. On the 2-year trend on the right, so sorry, before I get there, in the middle, you'll see that Canada also had an increase in growth. That dashed green line meant to represent the gains in the overall orange trend. They hit positive growth in around early Q2, then hit a little decline, then they hit another peak, the most recent peak in Q3, and they've declined since then. But it's, I think, volatility in the context of this macroeconomic environment. So finally, 2-year trend, Canada's looking a little bit softer. That has mostly to do with 2022 strength, but a little bit of the just the way that the last couple of weeks of data have come in and pulled that the right-hand side of that curve down. I think that will come up pretty soon. All right, let's look at individual technologies and how they're playing out. When you look at the chart on the left, what you want to focus on is the last set of bars on the right, week 40, where all of these categories of technology, the spending was up substantially. And that is a significant improvement over all of the periods to the left of that, where you've got some growth, but you've got at least a mix, and for many of the weeks, a predominance of declining shipments. So this is representing week 27 to week 40, which is essentially all of Q3 plus the first week of Q4, which is the one that's turned around. And then on the right-hand side, we've got a table to give you some numbers. You look at that right-hand week 40 column with the, lots of green. Software was up 74%, services essentially the same amount, PCs up 45%. Just a real turnaround and rebound from the prior weeks. Okay, if we look at longer term trends and how this plays out, we're extending the theme of recent weeks and the last quarter's presentation, which is that consumer devices in the dashed lines have been in recovery mode. In the latest data, you can see lows in 2023 for the blue, yellow, and gray lines. They've all come up, but they've also all recently kind of hit a peak and they've turned down. So PC had a growth below zero in 4 of the last 5 weeks. As I mentioned, the most recent week was up 45%, so pretty substantial shift. AV and CE, consumer AV and consumer electronics, and others are the other consumer lines. They've also flattened out just below zero. On the enterprise side, software has maintained the lead with near 10% growth. They were up 74% recently, following a decline of 20%. Services is in the solid blue line. That's trending below zero, but the numbers are not so different. So plus 73% in week 40. The issue here is that we had a couple of substantially bigger declines in week 38 and 39, which are down by around 30%. So that's pulling that trend down. And I guess it's worth noting that services has not been as resilient as software generally. Infrastructure hardware, the orange line there, hit a bottom in about week 24. It's been pulled down by recent weeks of negative growth. Was up 25% in week 40, but not at the, that's a pretty respectable number, but a far cry from software and services at plus 75. 2-year trends, enterprise spending remains solid. We've got both software and services remaining positive. Infrastructure is a little bit below that. And then consumer devices are all negative, reflecting the weakness in 23 and some into 2024, but they're also stabilizing and mostly turning around. And so as I've been indicating, I think particularly in the case of PCs, we're going to see those lines turn up in the coming weeks. Okay, software. The overall trend rose a little bit. Let's start with other software, which is the orange trend there. And if you look, you can see really substantial peaks and an upward trend. I've added a little dashed orange line to indicate that trend. But software spending hit an all-time high of $500 million in mid-August. That was up 31% on top year on year on top of the prior peak. So just, a significant increase in that seasonality and in that market. Year-to-date sales are up 24%. If you look at the trending line in the middle chart, the curve peaks at almost 30% and comes down. That is, it's worth observing, but it's not so much that that the weeks after the peak have come down a lot. It's just that when you smooth out a trend, they look, 25% looks low in comparison to peak of plus 31 all-time high. So anyway, worth noting. System infrastructure, if you look at the blue dashed on the left, you'll see that's the majority of shipments. They were down slightly from 13% growth, but still growing very solid. The softest segment is applications, which has hit a bottom of minus 22% earlier in the year. That's improved to minus 13%, but still clearly trailing the other categories. And then AD&D in yellow is the smallest of the categories. The trend looks like it's kind of falling off a cliff, but that, again, that's a little bit of an artifact of the way that the trending, we had recent weeks near 20% declines. But it's a little bit hard to see. If you look at the yellow volume line on the left, you'll see a significant spike at the end of each year. So you can see it in 2021, 22, and 23. It hasn't yet materialized in 2024, but there's, I think every reason why it should. Also, if you look at sort of the sizing, if you look very closely at the sizing of those, the bumps in earlier quarters, we're sort of just beginning that, well, it would be beginning of the Q4 seasonal bump. So I think when those materialize, you'll see that software, that AD&D trend line come up substantially. So this is now a comparison of the 1-year view on the left and the 2-year view in the middle. As you can see, the AD&D line looks much more stable when you look at the longer term trend. The overall trend is also accelerating. A large part of that is driven by other software. So the orange line that I focused on in the 1-year view looks even more dramatic in the 2-year view. That's because you're building basically a peak in 23 on top of a peak in, peaks in 23 and 24 on top of prior peaks that did not have, the 2021 that and 2022 that really wasn't as prominent a feature. So, all right, I got overall trends, other AD&D. So we will see more difficult comparisons going forward for software. So that'll moderate this, particularly the rise in other software. Let's see. Yeah, so system infrastructure software is the biggest category. We will expect strong gains. We'll expect slower gains despite the strong gains we saw in week 34. So that trend will taper off. App sales will remain softer, but again, in the 2-year view, we'll start to see some stabilization. Okay, services is our next largest and also dynamic category. Overall, we see the trend slipping just below 0. So we saw pretty substantial gains in July and August, but more recent declines in September have pulled that down. Other services are the largest category. That is had some double-digit gains in July and into September, but we have seen some recent declines that are slowing that down. Other support services peaked recently. So if I go, let me get oriented here on my growth. All right, warranties, there we go, blah, blah, blah. All right, so the gray line, you can see kind of the darkest circle. We've got pretty substantial peaks at the end of 2023 and recently. So we've had kind of either a compression in the peaks or potentially you could see see it as positive results. And it depends on if you interpret these as additional growth or a shift forward in growth. So if you look at the chart on the left, you can see the gray circle. It's highlighting a peak at the in the gray line at the end of 2023. We would expect a peak at the end of 2024. The peak that we actually see has already passed, so that's a Q3 peak. So if we get any strength remaining in this year, we get another peak, then that's going to substantially drive up the that line, the other support services. Similar thing is happening with warranties, the blue line at the bottom. So you see those green circles. We've had basically peak shipments early in the year. We see that 21, 22, 23 is highlighted. The more oval horizontal green line shows that we saw that late in 2023, and then we saw a peak in mid 2024. So compression of that cycle, peak, a fairly strong growth. The red oval is reflecting kind of gaps in that trend. So Q1 24 was substantially down, was more subdued. The last quarter also for warranties was subdued, and that reflects the slowdown in device sales. We're also likely to see a weak Q4 because we're comparing with a really strong Q4 in 2023. So that's why that on the middle chart, that light blue line is kind of waterfalling in recent periods. Finally, extended services in orange and phone consulting in yellow have stabilized, although they've been declining and they're relatively small compared to the other categories. All right, still with services, comparing the 1-year view to the 2-year view. Things in the middle chart are much more stable. We've got growth near zero, but it's slipped a little through 2023, but really not that much. The blue dashed line remains, other services remains the dominant category, pretty stable around 20% year-on-year growth. The orange line is slightly zero. That's our extended service agreements, pretty stable. And then warranties and phone consulting still are the weakest on a 2-year basis. But as I mentioned, if you look at the weekly trends and the potential for a Q4 improvement in warranties, then those ought to improve pretty significantly by the end of the year. There we go. All right. Personal computing. So PCs have had some similar volatility. We had a really big bump in sales post-pandemic or during the pandemic, so 21 and 22. We saw decline significantly in 2023, and in 24 we had a rebound through the second quarter, and then we've had some softness. So in particular, if you look at that left-hand chart, the dashed blue line on the top, you've got a pretty sharp peak. That's week 26. That was up 20% year on year in the June-July timeframe. Since then, it came down and had a couple of quarters below zero. But overall spending, as I mentioned previously, was up 25% in the week 40 results. Excuse me. Overall PCs closely follow notebooks. So in the middle line, you can see the dashed blue and dashed red are pretty well aligned. Desktop and workstation growth trends were pulled down by July and August, but they've turned up and recently saw double-digit gains in week 40. Tablets are a smaller category. You can see on the middle chart, they have been slower growth for a longer period of time. So very little boost, very little growth, even in 2021, negative in 22 and 23, but more recently they've trended up. So if you look at weekly results, you'll see some up and downs, but trend-wise, they are stabilizing. And then finally, PC Others is a pretty small category if you see it at the bottom of the left-hand chart, but it's seen gains of over 40% in August and September, and trending up as a result. All right, finally, we've got the one-year trend on the left, two-year trend in the middle. Net result is all of the categories are turning up, but they remain negative. So, you know, all of the things I've already said about trending and the macro environment supporting a rebound. I hadn't mentioned, so in the overall market, we're expecting we have very similar trends. So we have end of support for Windows 10 looming. That's going to drive commercial refresh cycle into especially 2025, but also 2026. We expected, and we've actually seen this play out in the broader market, that we expected a larger growth in Q2 24. Then we saw kind of a softening demand, which was reflected in distribution trends as well. And then Q4 is looking more positive. You've got an easier year-on-year compare, and we've actually heard sell-through has improved in Q3, basically setting the stage for a rebound in shipments there. So most of the categories are pretty well synced. What I would point out, desktop actually did peak above 0, lifted by recent comparisons. And then PC Others is the one that has shifted the most. So big picture turning up. As I opened with, the economic environment should also be more favorable. Let's cross our fingers for the next 2 weeks and see if we can build on this growth. So let me now pass it to Gabriele, who's going to talk a little bit about opportunities and how to manage our channel ecosystem.
Thanks, Loren. Hope you can hear me fine. Thank you also GTDC for hosting this webinar and for having me. It's a pleasure to be here today. So over the last few months, I have been talking with a lot of channel leaders about what they're feeling as their priorities and challenges. So today, I would like just to discuss how I feel like these challenges and these priorities can be addressed with what we call partner intelligence. So I'm Gabriele Roberti. I'm Director for Data Analytics in IDC, really covering partner intelligence and partner ecosystem. So let's get into that, into my presentation. So what I would like to start from is, something is happening here. Okay, is ask you the first question I always ask in my conversation with channel leaders is, what is your first priority as of now? And I would be really surprised if the majority of the answers in this poll is not around the magic word, the growth, right? We heard a lot of growth sentences and words now in Loren's presentation. We heard about how things are basically stabilizing on the macro level, and finger crossed for the next weeks as well. But looking at the next period, of course, is focus of many channel leaders is how can they achieve growth over the next year, basically, right? And so I think this resonates a lot. And if we look at where you can get the growth from is basically from this worldwide, very broad opportunity. What I'm showing here on the slide is just the hardware and software opportunity. And then on top of that, we can count the services opportunity, of course. And many of the services are to enable solutions in the hardware and software space, right? So this is the large pie where everyone basically is battling for getting their growth into next year, right? And how can you achieve this growth? I think there are three main paths to growth. The first one is purchasing companies, so acquiring revenues. Second one is investing in direct sales to basically to get to the end user customer. And the third one is through partners. Now, since the macroeconomic conditioning and business environment is a bit stabilizing, but we are not there yet, I think, for an M&A situation. And actually, many of the companies that I've been talking to, they say that the requirements is to do more with less, and they are not doubling down on direct sales teams and forces, right? So I think what we remain with is the partner way to market, which is actually the main way to get this growth from, right? So if we look at that 1.9 trillion opportunity, 65% of that in next year will be transacted through partners. And if we focus outside the service provider spending, and we focus more into maybe segments like SME or mid-market, or even those solutions that require very heavily services-based approach, that share is becoming higher, okay? So that's why the partner route to market is essential for everyone, and why I think partner intelligence becomes your competitive advantage. And partner ecosystem are very strange beasts, and they are complex, and often they are inefficient. In fact, second question I always ask to the people I talk to is, what is the percentage? What do you think is the percentage of your ecosystem that is actually performing good? Okay, and I think if I ask you this question, many of the answers will be around the 80-20 rule, right? So 80% of the business is done by 20% of the partners. This resonates with this IDC research from March, which says that 80% of partners are going to miss out the AI growth opportunity due to skills gap, basically. But actually, the recent conversation are even more pessimistic, and they are around less than 10% of my ecosystem is performing as I would expect, as I would like to perform, right? So this highlights main common pain points, like difficulty in identifying the right partners, the visibility into what are the partners' capabilities and performances, how can vendors and distributors have effective partner enablement and support, how can distributors can be even more valuable and meaningful for vendors, and how can everyone basically beat the competition, because we're not alone on the market, right? So those are the key points that I have from the conversation that I had with channel leaders. And I would like to give my perspective on three use cases, key use cases, let's say, and I will use the insights and the data from the IDC channel partner ecosystem, which is one of IDC's partner intelligence tool that covers broadly on the worldwide level more than 570K companies in the vendor community, in the distributor community, and overall partner community across all the geos in the world. And we establish what are the capabilities of the partner, of this partner, who are them, and how they are linked to each other, and which are the relationship, right? And I think there are a lot of interesting insights that I'm going to share. So the 3 use cases that I'm going to cover in the next 5 to 10 minutes are around how to find the best fit partners for your needs, how to cultivate a more effective partner ecosystem, and how to look at the competition there. So let's start with the first one, identifying the best partners. So many times companies don't know about their partner, who are their partner, what are they capable of, right? And how can they identify within their partner base or outside that, who are the best partners for their strategy? Why? So, or not just for the strategy that is a long-term initiative, but for short-term initiatives, for initiatives that are in the next months, for campaigns, for go-to-market initiatives, right? So questions like, do I have the right partners? Do I know them? Can I look for new partners, and how do I look for new partners to expand into new areas, new capabilities, and eventually is where I'm looking for growth, right? Who are the partners that can enable me to reach to that growth? So I think with partner intelligence, what you can focus on is on different criteria, right? One of these criteria is, for example, the locations. We're talking about North America here, and I just did a quick check on which are the top 5 cities in North America for number of partners, right? Where are the most partner located, where they have the richer partner ecosystem, right? No surprises, cities like Los Angeles, Miami, Toronto, New York, they come up, okay? But then the location is important as you want to enable some specific locally specific initiatives, right? Some of our clients, they want to go for the ISV ecosystem, for example, in different cities, and understanding where they can get the best pool of partners there, right? Capabilities are really important as well. We saw how only 20% of partners were AI ready for getting the AI growth opportunity, right? And in fact, AI is not in the top 5 capabilities in our database that we see for partners, right? We have cloud, mobility, IoT, and then security and big data and analytics. But choosing the right partners for getting to the specific capability area is not easy. And so that's why you can have tools it's better to have tools that help you doing that job quicker. And then third aspect is looking at the relationship of the partners, which relationship they have. You might want to, let's say, stay away from partners that have certain relationships because they are competing. These relationships are competing with you, and you might want to be bonded to some of the partners to explore their relationship, right? So here's just 5 of the vendors with most partners in our database. No surprises, I guess. But this is just to say that relationship has a different role and maybe dual role in this game. How to enhance the ecosystem effectiveness. Second use case, sometimes you don't want to expand your ecosystem, you just want to invest in the right partners that are in your ecosystem, and you need to know where to focus your attention, where to focus your resources, and how you can spot that 10%, and how to understand how that 10% can maybe, the rules for this 10% can be applied to another 10% of your partners that can deliver the same capabilities and the same opportunity on the market if you invest in the right way with them, right? So this needs to be maintained and as an alignment with your partner strategy, your company strategy, and what the partners really do. This is a matter of also role and responsibility. Sorry. Role and responsibility on, there we go. On the partner ecosystem, you want to invest in collaborations where you find the best way to market and the partners that complement your role in the market. We're talking about system integrations, which is the actually the largest pool of partners that we have in the database, that we see in the database, right? System integrators with different capabilities for different partners. Some they can deliver really specific, locally, geographically located capabilities. Others have a larger scale, a global scale. But let's think about the differences about resellers, value-added resellers, and service providers. These boundaries are increasingly getting blurred, right? So assessing the right partner type and what they can deliver as a role and responsibility in the market can really make the difference, right? And you might want to take a look at the technologies they can work with. So looking at which one is able to work on your technology, but also looking at the technology adjacencies that you can maybe exploit as complementary to your focus point. And also the industry capability, right? 30% of the partners that we have in our database don't have any industry focus. We call them industry agnostic, okay? And that might be important for you, having such partners. But maybe you want to focus on a specific industry or specific sector for what you want to deliver in the market. And then you have to find the right partner to invest in, to work with, right? Only 1/5 of the industry-specific partners are devoted, can work in public sector, actually, right? So it's important to identify them quickly and at scale, and to enable initiatives on those partners only. And then onto the third element, the third use case about competition. I think it's important to map the partner relationship with you and your competitors to understand the gaps. And the gaps could be gaps that you have to fill to have a more competitive positioning, but also the gaps that you can exploit, the gaps of others that you can exploit, right? So let's just take a look to this first part of the picture, where you have security software vendors, some of the security software vendors from our IDC tracker, and there's a comparison of how big is their partner network. You start understanding a lot of interesting things when you look at their partner network and just the size of the partner network, how they work with their partner network, right? But if you can also complement this view with the overlap of this network. So this light blue color map indicates the network overlap, the partner network overlap. So the darker it is, the higher is the partner network overlap between the vendor on the top and the vendor on the side. So just to give you an example, let's focus on the last column. We can see that Checkpoint has a higher partner network overlap with Palo Alto versus Palo Alto Networks versus McAfee, for example. We don't have here in this chart actual values, just color shades, but this lets you understand how would be important to understand not just what are my partners, what are my competitors' partners, but also which partners are in common and which are the partners that I can reach out to, because they are not in common between me and my competitors, but also there could be others that are interesting to look at, right? So partner intelligence can give you this kind of data and really help you focus on the things that you want to do quickly and at scale. So just concluding my presentation here, if you want to achieve growth, a solid indirect route to market is basically required. And it's complex, but some partner intelligence can allow you to informed and faster decision making, and basically doing more with less. You can understand how to be more meaningful and valuable for your partner, whether you are a vendor or a distributor, and you can really take a look quickly and in a quick way and an easy way to capabilities, relationships, profiles of different partners, and mix all this information to find the best focused list for you. What I've been using in this presentation, I said, is the channel partner ecosystem. You'll find here a link with some more information on how to compress your three-year strategy in months and delivering faster your results, basically. But the channel partner ecosystem is just one piece of the puzzle of what IDC can provide for managing, developing your channel strategy, execution, governance, and channel optimization. So we'll not go on all these items. We'll leave just this material here, as well as the material on how important would be to not just look at the partner intelligence, but also mix this with the market intelligence, with the account intelligence and the contract intelligence to have an overall 360 view of the data, of the situation on the market. And this is enabled by a IDC with more than 7 billion data points in the backend that we take care every day, basically. That concludes my presentation. So thank you very much, Loren. I will give up my remote control here and pass it over to Kavita. Thank you.
Thank you, Gabriele. We did have one question, and I know we ran a little bit over, but we have a couple minutes left here before the hour. Should the target be expanding partner network in a controlled way, invite-only program, for instance, versus an open program that allows sign up across the industry and paring back over time based on partners that engage?
Oh, that is a good question, and I don't think there's a one size fit all kind of strategy, right? I think that what you need to do is having information and insights on the partner network. There will be some partners that you need to target specifically that you can identify to be your focus point. But then also you can have like a more broad program and accept more partners there. And the key would be understanding how to invest in the right partners, right? So for sure, a targeted approach is needed, I think. But also you can work with the same kind of approach in looking at, in a broad way, in the larger audience of your partners, where are the key partners that you want to invest in. And also another important point is that partner strategy and initiatives, they change over time. So you can really switch your attention and your approach while ongoing in the ongoing activities. So targeting for one activity some type of partners and switching approach for different and these different strategies for different targeted initiatives, right? So the important is having a way of understanding what you have at hand as opportunity from a partner standpoint, and then directing your kind of focus to the right ones.
Thank you. I think one more. Oh no, that's it. I think we're done with questions. If anybody has any additional questions, here's contact information for both Loren and Gabriele. And if you're interested in learning more about the GTDC and the research we have available, please visit our website at www.gtdc.org. And thank you again for your time, guys. More to come.